Welcome to The Explainer. So glad you're here. Look, if you're operating a heavy industry business in the land of the living skies, you already know your success doesn't just depend on hard work. It depends on heavy, specialized, and let's face it, incredibly expensive machinery. But actually acquiring that gear? That's a massive financial hurdle. So let's dive right into this core dilemma and unpack exactly how you can finance the machines that keep Saskatchewan moving.
Seriously, how do you afford a $500,000 combine, or a massive hydrovac truck, or specialized underground mining gear? The upfront cost of this heavy metal is just staggering. We are not talking about buying a standard pickup truck here. These things are literally mobile factories. For most operations, buying a whole fleet in straight cash simply isn't a reality. And honestly, tying up $500,000 of your working capital in a single piece of iron is often a strategic misstep, even if you actually have the cash sitting in the bank. What this means is that your business's growth hinges entirely on understanding how to effectively leverage capital.
Here is our roadmap for today. We'll start with fueling the dual economy, then look at financing versus equipment leasing. Third, we'll cover the top Saskatchewan leasing companies, followed by navigating provincial sales tax. And finally, securing your equipment approval. Let's get started.
Section 1. Fueling the dual economy.
So the crucial point here is that Saskatchewan relies on what experts call a dual economy. On one side, you've got this massive agricultural sector producing wheat, canola, and pulses. This is large-scale farming, right? It requires enormous four-wheel drive tractors and highly advanced air seeders. On the flip side, you have a world-leading potash and uranium mining sector. That industry demands rugged, specialized underground gear and heavy-haul service trucks that can really take a beating. And of course, linking both of these massive industries together is the urban and rural construction sector. Because these pillars require such completely different, highly specialized assets, the financing market here has to be incredibly adaptable. You just can't use a one-size-fits-all approach when you're jumping from a precision ag drone to a subterranean rock crusher.
Now, what's really fascinating about this dynamic is how local lenders have actually adapted to the reality of the land. In the ag sector, income isn't some steady, predictable monthly paycheck, right? It arrives after the harvest. Well, equipment financing structures in Saskatchewan actually respect this cycle. Lenders offer harvest-aligned, seasonal payment schedules. They know that forcing a farmer to make peak loan payments during the incredibly expensive spring seeding season makes absolutely zero sense. I mean, your capital is literally going into the ground in the form of seed and fertilizer. So they tailor the terms to match when the cash is actually flowing. It ensures the financing supports the operation instead of choking it.
Moving right along to Section 2, financing versus equipment leasing.
Okay, so you stand at a crossroads, leasing versus traditional financing. Let's break down the mechanics. Leasing really greases the wheels of your immediate cash flow. It's all about capital conservation, keeping your powder dry for unexpected expenses or, sudden opportunities. Leasing also gives you access to the latest technology every few years, which is absolutely critical if you're in an industry where efficiency relies on modern GPS or automated tech. Plus, the payments can often be written off as tax-efficient operating expenses. Traditional financing and loans, on the other hand, like those term loans or government-backed Canadian small business financing options from institutions like Connexus, well, those are all about the long game. You are building equity. You're working toward eventual long-term ownership of the asset, and you get the ability to lock in your interest rates to hedge against inflation. Basically, your choice depends entirely on whether your strategy right now is to conserve cash today or build equity for tomorrow.
Section 3. Top Saskatchewan leasing companies. If you're looking to lease, you've got several heavyweight local providers operating right here in the province. And it's interesting because each one has a very distinct personality. Caledon, for example, is known for highly flexible terms and hassle-free upgrades. If your business needs to constantly cycle in new equipment without a massive administrative headache, they're a great fit. Then you have Stride Capital. They excel at incredibly smooth, quick transactions geared towards strategic growth. Say you land a massive contract out of nowhere and need 3 excavators by Monday. Stride is built for exactly that kind of speed. Pearl & Co. is famous for getting right down in the dirt. They really understand the work boots reality of heavy machinery. If you're running a gritty, tough operation, that's their wheelhouse. Finally, Dynamic Capital is the powerhouse for heavy-duty gear, aggressively focused in helping you grab sudden market opportunities. Impartially speaking, there's no single best lender here. It's all about matching your specific operational style to the lender's unique strengths.
All right, Section 4, navigating provincial sales tax.
Now, let's untangle some of the bureaucratic red tape. If you want to avoid a massive headache, you really need to pay attention to the official Saskatchewan e-tax services guidelines. specifically Bulletin PST 72 regarding rental businesses. Tax compliance is absolutely not an area where you want to guess or take shortcuts. A mistake here, especially an audit finding years down the road, eats directly into your profit margins and can completely cripple your cash flow.
So, the tax trap you need to avoid comes down to a really simple binary difference. Are you getting an operator with the equipment? If you hire equipment with an operator who controls its function, say an audiovisual setup where a tech runs the board, or a backhoe that comes with the driver, that's actually considered a non-taxable service. As the customer, you are exempt from PST on that rental. But if you rent the exact same equipment without an operator and your own team takes the keys and controls it, it's suddenly classified as a pure equipment rental, and taxable rental charges absolutely apply. It's a seemingly small distinction, but it has massive financial implications.
Let's look at how these distinct rules apply to some very specific, real-world scenarios on the job site. Take crane rentals. The crane itself is taxable, but the operator's time is exempt, but only if you segregate that charge clearly on the invoice. If it's all lumped together, you might end up paying tax on the whole amount. For scaffolding, the equipment rental is taxable, but the heavy labor component for setting it up and tearing it down is exempt. Portable signs, those are exempt if the owner sets them up and controls them, but taxable if you just rent the sign to place it yourself. And those massive disposal bins left on your construction site, those are generally considered a non-taxable service. Knowing these exact rules ensures you don't overpay a single cent in taxes.
Finally, Section 5, Securing Your Equipment Approval.
What's truly unique about agricultural lenders in Saskatchewan is how they actually view credit. They understand the concept of what we call survivor marks. If your credit score took a hit because of a massive drought 3 years ago, or maybe a sudden, uncontrollable drop in global commodity prices, specialized lenders don't just automatically feed your application into some rejection algorithm. Instead, they look past those bad credit blemishes to evaluate the fundamental strength of your operation. They're looking at your actual land base, your historical crop yields, and your current revenue potential. They finance the reality of the farm, the resilience of the operator, and the quality of the dirt, not just a 3-digit credit score.
Okay. Getting your operation fully funded is actually surprisingly straightforward. It really just comes down to 3 steps. Step 1, gather your documents. You'll need your financial statements, tax returns, and, if you're in ag, your crop history. Having all this organized up front saves days of back and forth. Step 2, submit your application through a dedicated leasing agent. A good agent dots all the I's and crosses the T's for you, presenting your operation in the best possible light to the underwriter. And Step 3, receive your credit decision. For many of these specialized lenders, because they understand the local industry so intimately, that decision happens within 24 hours.
The most optimistic number you need to remember today is 91%. That is the actual approval rate for submitted applications cited by Equipment Finance Canada. Honestly, it's a massive number. It just goes to show that if you structure your application correctly, organize your financials, and use a lender who actually understands Saskatchewan's dual economy, the capital is absolutely there waiting for you. You aren't begging for a loan. You're partnering with capital providers who are eager to deploy their funds.
I'll leave you with this provocative thought to consider as we wrap up. Is your capital tied up in aging iron? Think about it. Every single dollar you have locked into a depreciating, outdated asset is a dollar you can't use to seize a new contract, expand your acreage, or upgrade your technology. Whether you choose to lease or finance, making a strategic move with your equipment is the ultimate key to growth in Saskatchewan. Thanks so much for joining me for this explainer, and I hope this helps you make your next heavy machinery decision with absolute confidence.